The market is absolutely weak, heavily reliant on stock buybacks and central bank easy monetary policies. Now that we have seen the yield curve inversions, the bond market looking worse and worse, stock investors are beginning to look for the Fed to drop interest rates. The entire fate of the stock market rests upon the shoulders of the printing press. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the markets. I think that there's a lot of progress here. I wanted to cover it beginning with the actual markets themselves. As you can see right here, we're looking at a sea of red. This happens to be typical in the last month or so. You can see the S&P 500, NASDAQ, and the Dow Jones all down for the day. Also, the Asian markets are looking like they got the contagion, they got the virus that was present in the US today. Now, I'm just showing you what has happened over the last 3 months, but if you go back, obviously since the beginning of this year, we have seen a dramatic progress in the markets after really suffering horribly throughout the fourth quarter of 2018. Corporations were the biggest buyers of stock during the bull market, but now they are selling. Now you have to understand how important that is because the corporate buybacks, stock buybacks, have been so integral to the success of the stock market from 2009 up until today. It is only second to the actual central bank quantitative easing policies that have kept this market going. When you look at the actual technical biggest buyer of stocks is actually the companies themselves. It begins to really paint an interesting picture. Now they're selling. Typically, the public is considered the crowd in stock markets, buying the most at the top and selling the least at the bottom. But corporations are stepping into the role of the so-called dumb money. Corporate stock offerings have soared in the past 40 years. They're slowing down this year though, likely due to the trade issues and global uncertainty. Strong public selling should be bullish, but perhaps the crowd in this cycle is the corporations. Interesting article that they wrote about here, and we saw last year it was about $1 trillion worth of stock buybacks. Initially, at the very beginning of the year, it looked like the progress was going to be even further than that, but this article here is telling me something else. Stock buybacks drive prices, so you can see here going back, I guess, into the 90s up until the present. Obviously, there has been a complete correlation with the stock buybacks and what you're seeing in the US markets. They're showing us the S&P 500 on the top and the net issuance here at the bottom. And as you can see, obviously, when they are doing a lot of stock buybacks, the stocks are rising. When they are encountering a recession, then obviously it's the opposite. Now, this tells us something about how important stock buybacks are to the market. And it could be something where, as I have shown you previously, when these companies are in fact engaging in buybacks, they then actually sell the insider trading, they sell shares after the stock gets a boost. This has happened over and over and over again. I've documented that here on the channel. You see a boost from the stock buyback and then the insiders will sell. This happens over and over and over again every single time they do buybacks because they are a regular occurrence, and this happens to be just one of the ways that we have seen things really differ this time versus the previous cycle where they have gone to excessive levels. Scary pattern forming in stock chart may be a sign of another move lower. So I'm not saying that. I'm going to show you the chart here in just a second. But of course, this is what they do, the technical analysis, and I'll show it to you. But as always, take it with a grain of salt. A so-called head and shoulders pattern looks to have formed in the S&P 500, a sign to some technical analysts that the market has reached a near-term top and could be heading into a rocky period. The S&P 500 broke what would be a neckline Wednesday after it traded below 2,800. 2,800 seems to be a very important number for the S&P 500. We have seen this time and time again. It broke through that level after being stuck at it for so long, and then it fell through again. So it seems to be a hard resistance, and they can't keep above for a long period of time. This is the chart just for your reference. Obviously, S&P 500 wanted to give you that. It might be hard to see. Font is quite small, but I just wanted to show it to you. I'm going to move on. 3-month yield tops the 10-year rate in the widest curve inversion since the financial crisis. At the bottom, you can see the 3-month and the 10-year. This is something that traders are watching. The algorithms are looking at. The financial analysts always point to. When you have the yield curve inversions taking place, it is only a matter of time before a recession happens. Doesn't mean it's going to happen tomorrow or the day after, but this is the primary indicator of a recession. It's basically the warning that people need in order to understand it's coming. Now, it doesn't necessarily invert and then the next day that is it. That's the signal. It could very well turn around, and this does happen, as you can see. But if it remains below that point for a period of time, then you know it's going to stick. I should also mention that it actually is on the way back up. When it's heading back up that we tend to see a recession, not when it remains below. So let's keep our eyes peeled. Long-term government debt yields fell further below rates on short-term notes and bills during Wednesday's session, an unusual bond market phenomenon often heralded on Wall Street as a recession prognosticator. Here they're talking about the 3-month and the 10-year, essentially just showing you the yield curve inversion is starting to worry these investors, these traders, and people should be paying attention. The paragraph at the bottom explains it perfectly. The yield curve is sending a warning about economic growth in the United States and the world. Many investors and economists believe under normal market conditions, those that buy debt from the US government for years are compensated with better interest rates than those who loan money for a matter of months. So obviously you're taking a risk the further out you go, and you should be compensated for that. However, right now that isn't the case. That's when you know it's messed up. All of this, of course, is because of the central bank activity and what they do. They mess things up, and then you have it basically all coming to a point, and that is when we have a recession. Nobody knows how it's going to happen or how it's going to all unfold, but of course, these tend to be the signals which lead up into it. U.S. government bonds gain as growth concerns deepen. I found this interesting information here at the bottom. The decline in yields has been a global phenomenon. German 10-year bond yields fell further into negative territory after a report that said Germany's unemployment rate rose unexpectedly. The 10-year Australian government bond yield dropped to a record low as well. They've got problems in Australia. You've seen what's happening with the real estate. Their prices have fallen dramatically. I believe Sydney was down almost 15% the last time I checked. Some other areas are down much more than that. So we're looking at a fallout that is occurring in the major cities in Australia. Germany is dealing with their own issues, negative yields. I mean, what kind of world are we living in today when you can't even get a positive yield? Anything, even anything. But no, you're getting a negative yield on the fact that you are going to give up your money for the privilege of them holding it for you. My goodness. And just to finish off the video, the Case-Shiller 20-City Composite Index year over year, showing you that the big cities in the United States have seen a price decline, and that gives us this idea that things are not what they used to be. I know it would be amazing if there could be a perpetual boom. We would never need to worry. Just have faith in the Federal Reserve. Just have faith in our central bank, and they will take care of everything. But of course, time and time again, we realize that that isn't the case at all. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you are supporting me and this channel. I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. You can get all the details at the link in the description. I talk about tax incentives, reducing your expenses, self-sufficiency, everything you need to know. Check it out. Click on the link. If you want the audiobook, that's available at themoneygps.com. The economy is not doing well right now on so many levels. In this video, I break down exactly what you need to know. So click on it and I will see you there.